The global economy is walking a tightrope. Soft landing or hard crash, central banks, markets, investors, everyone is holding their breath. If you want to understand what's really happening behind the headlines, you're in the right place. New to finance? Start with the explainer video right now. Want more depth? Listen to our weekly market podcast, available in English, French, German, Italian, and Spanish, right here on the channel. Like if this helped you see the bigger picture. Share it with someone trying to make sense of the markets. Subscribe for sharp market insights every week. Let's decode the markets.
All right, let's dive in. Right now, the global economy is, well, it's walking a tightrope. Seriously, on one side, you've got the hope of stable growth, and on the other, the very real risk of a sharp downturn. Central banks, investors, everyone is kind of holding their breath, trying to figure out which way things are going to tip. So let's break down this incredibly delicate balancing act.
And this really is the billion-dollar question, isn't it? Is this going to be a soft landing where everything sort of gently comes back to normal, or are we staring down a hard fall? That's what every single investor is trying to figure out, and right now, the data is just pulling us in two completely different directions.
And this slide, this gets right to the heart of the problem. On the one hand, we've got cooling inflation, and that is fantastic news for pretty much everyone. But on the other hand, the engine that drives economic growth, it's really starting to sputter. This push and pull is playing out differently all over the world, so let's kick things off with the biggest economy of them all, the United States. So first up, the US, which honestly is sending some of the most confusing signals out there. It's a real economic puzzle right now. You can really see the core of the US dilemma right here. We got a surprisingly good inflation report. Exactly what the Federal Reserve wanted to see. But at the exact same time, we got some news from the job market that's making people pretty nervous, suggesting the economy might be a lot weaker than it looks on the surface.
Let's dig into the numbers for a second. Inflation coming in at just 2.7%, that was way below what anyone expected. And core inflation hitting its slowest pace in nearly 5 years. That's a huge win. But look at the other side of this. Unemployment jumped to 4.6%, a level we haven't seen since early 2021. You add that to fading business momentum, and it really looks like the economy is starting to show some cracks from all those higher interest rates.
And you can see this uncertainty playing out perfectly in the stock market. The tech-heavy NASDAQ, which is still kind of riding that AI wave, it managed to eke out a small gain. But if you look at the broader market, like the Dow, and especially the Russell 2000, which tracks smaller companies, they both fell. The market itself is totally divided on what to think.
Yeah, this quote just hits the nail on the head. It sums it all up, right? Sure, the Fed has more wiggle room now that inflation is coming down. But the really crucial point here is that a soft landing is no sure thing. Not when the job market starts to get shaky.
Okay, so that's the US. Now let's jump across the pond to Europe, where policymakers are taking a very different approach. While the US is holding steady, it looks like Europe is making this cautious pivot toward cutting interest rates. And this table really lays out the different moves. You've got the main European Central Bank, plus Sweden and Norway. They all decided to hold rates steady. They're still worried about inflation. But, and this is the big one, the Bank of England came out with a surprise and decided to cut its key interest rate.
And listen, this wasn't just some routine rate cut. It was a total surprise. And get this, the vote was razor thin, 5-4. That kind of split decision just goes to show how torn policymakers are, even inside the same central bank, about what to do. Do you keep fighting inflation, or do you try to stimulate growth? They can't agree.
Now, for what might be the biggest story of the week, a truly historic shift happening in Japan. After decades of ultra-easy money, they are finally breaking the mold.
To really get how massive this move is, you have to look at this timeline. The last time Japan's benchmark rate was this high was way back in 1995. For the last 17 years, rates have been at or near zero. So this isn't just some small policy change. It's literally the end of an entire economic era for Japan.
And here it is, the new number. The Bank of Japan's benchmark rate is now 0.75%. After years of negative interest rates, this is just a profound shift. But here's where it gets really weird. Normally, you hike interest rates and your currency gets stronger. It's economics 101. Well, the opposite happened here. The yen actually got weaker. So why? It's because the market is skeptical. Traders just don't believe the Bank of Japan is ready to do more hikes anytime soon. And that tells you they're still very, very cautious about Japan's fragile economy.
All right, last but definitely not least,
let's shift our focus to the world's second largest economy, China, which just seems to be stuck in a persistent slowdown.
Just take a look at this number. In November, retail sales grew a mere 1.3%. That is the weakest consumer spending growth we've seen since the pandemic lockdowns. It's a huge, flashing red light that the Chinese consumer is in trouble, rattled by a property crisis and a shaky job market.
And if you thought that was bad, it gets worse. Fixed asset investment, things like building factories and infrastructure, it actually fell by 2.6%. This is on track to be the first time that key number has shrunk for a full year since 1998. It's almost all because of the ongoing collapse in real estate construction.
So the big takeaway here is that China's challenges are coming from all sides. Industrial output missed forecasts, and Beijing seems really hesitant to roll out any kind of massive stimulus. That leaves their whole economy dangerously dependent on exports, right at a time when its customers around the world are also slowing down. Not a great spot to be in.
Okay, so we've seen all these diverging paths of the world's major economies. So what does it all mean for the week ahead? Let's break down the biggest risks that are now on the horizon.
We've boiled it down to 5 key things to keep on your radar. First, in the US, we've got more growth data coming that could totally change the story. Second, any sign that inflation is getting sticky again could really spook investors. Third, in China, the big question is, will that consumer slump get even worse? Fourth, in Japan, the central bank's credibility is really being tested. And finally, you always have the wild card, a geopolitical surprise.
Now that 5th risk is especially important right now. Why? Because we're heading into a low liquidity holiday week. As this slide explains, that just means there are fewer people trading, so any unexpected piece of news, good or bad, can cause these huge, outsized swings in the market. It's a time you have to be extra careful.
And so that brings us right back to where we started with one big question. The US is betting it can pull off a soft landing. Europe is making a very careful pivot. Japan is finally tightening after decades of waiting, and China is just trying to get its economic engine restarted. Every major economy is on a different path, making a different bet. The question for 2026 is, who got it right?
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.